Welcome to the 3-Minute Trading Coach. I'm Brett Steenbarger, and today we have the second in our two-part series where we're going to talk about turning your trading ideas into good trades. So in the last video, which I'll link on the page, you learned that a good trading idea combines two elements. One is an element of direction or trending, most recently in the stock market that's been up, and superimposed on that trend, we find cyclical behavior, ups and downs. And what we're trying to do is locate oversold points in the market, if we're going to be long, that occur at higher price lows. So we make a cycle, and then the next cycle has a higher low, and the next cycle has a higher low. And we're using those cyclical highs and lows potentially as places to add risk on the lows, the higher lows, and maybe take some profits tactically on the cyclical peaks. Now, how do we implement that for good risk reward? The rule here is that when we talk about executing good trades, we have to look at a time frame, a time scale that is finer than the time frame of the trade idea. So let's say that the trade idea that I'm looking at is based on cyclical behavior on a daily bar chart. I'm going to use intraday bars to show me good places to enter and to exit. Now let's think about what's happening when we get these market cycles. We get, let's say, market selling, market peaks, and now fresh sellers come in. We see an increase of volume. We see much more negative NYSE tick readings in the stock market. So we're seeing new sellers, and typically there'll be some momentum activity to the downside. At some point, that downside behavior is going to create a level of value in the market that attracts new participants. Longer time frame participants perceive the value and they start to buy. And so the selling starts to level off, and then we see some impulse of buying because these new participants are longer time frame participants and they're larger participants. And so typically coming out of a low or coming out of a high, we'll see some impulsive behavior. We'll see some thrust as the increased volume leads to buying after a low, or selling after a high. What we want to do to execute with good risk reward is identify as early as possible when that thrust is occurring, when these new participants are buying off a low, get in quickly as if it were a breakout trade. Think of it as breaking out of the level that we had established at the lows. And if that's a valid breakout, we should not revisit those lows. So it gives us a point of reference to lean on as a stop, and we go with that new trend. By looking at the shorter time frame to time our entries and exits, we create good risk reward to participate in a more meaningful move. Now, this coming Sunday at 7 o'clock Eastern in the evening, I'm going to be holding the first of a trader's happy hour that I discussed in an earlier video and in an earlier blog post. And I'll link my blog post on the topic on this video page for those who might be interested in signing up. It's free. There's no obligation. I don't do any marketing or anything like that. But the participants will be sharing ideas with each other. It's a unique format. And I'll talk more in detail about the dynamics of finding good trades and good ways to implement those trades. Thanks again for your interest. Look forward to seeing you.